Hey guys, John with TRD Trader here. So I just want to provide a end of the week summarization of the positions that I went over on Sunday or Monday whenever I published the video, and to show you what gains that I had. And I also, before I do that, you're going to see this 27,416. For whatever reason, that number is going to change slightly by a couple of dollars here and there throughout the weekend. So if you see that this is a different number Monday, it's nothing that I did, just the way Webull updates. For some reason it changes every once in a while. Come on, go to place. Sit up. Come on, up. Come here. Let's go. Up. Anyway, so yeah, that number's going to change slightly. And you'll see here was my positions. Go boy. Go to place. Go boy. You'll see here's some of my positions. Mostly puts with one call. This is the one call I had. Here's the puts that I had. As I had said earlier in the week, I had got ASO stock and Halliburton stock. I went ahead and sold the ASO stock. I kept the Halliburton until it was profitable, and I sold a call on it, so I can't really get rid of it until this call is done. And then next week I might even look at what kind of premiums I can get for the call next week, because if I can get like a 2 to 3% return on the calls, I might just sell slightly out of the money calls until I'm able to get rid of the stock. But other than that, so let's go into let's bring up the calls I had called out last week. So you'll see that I had called out these stocks: Blink, CLR, Fubo, MVIS, Riot, Workhorse. I had called them out at 30 strike prices of 37, 33, 27, 17, 30, 13.50. These were generally the floors that I saw. Let's go ahead and see how those stocks are doing now. Their month-over-month activity. Let's go to Halliburton. Actually, let's go in order. Let's go to Blink. As you'll remember, I called out a $37 floor. Let's go to the 5-day. It started at 39. I called it 37, which is right about here. Went down a little bit and then shot up. You know, the S&P and the NASDAQ, they both went up. So it fell, shot up, so that was a good put call. And then I also called CLR. I had called a floor of 33, which was about below this graph. It basically shot up. I had called Fubo with a floor of 27. 27 is just slightly below this graph. It shot up. I remember on Fubo, I bought myself out of my put twice, and I resold another put for a higher dollar amount. So that's what I call chasing the floor. Obviously, I work throughout the week, so I don't have time to make videos of it. But you can see, like, it jumped up and then it traded sideways a little bit. Not trade sideways as much as it consolidated and people who had profits sold off. And then it jumped up again. This is probably a gap up in the morning. No, that's in the afternoon. This is a gap up in the morning. A gap up is when the stock jumps first thing in the morning because a whole bunch of people have buy orders, and so it jumps in the morning. So this was a gap up in the morning, and then this jumped up in the afternoon. This is another gap up in the morning. It was already jumping in the afternoon. The market closed, gapped up again. So, but basically, one way you can increase your return every week is as puts devalue throughout the week, you can buy them out for 78, 82, 85 cents on the dollar, meaning if you sold a put for $1 per share, you can go out and buy yourself out of the put for maybe 22 cents or 18 cents on the dollar, and then you can sell puts at a slightly higher strike price and get more premium, get a higher return. Let's go MVIS. MVIS, it started way up high. I had called a floor of 17, and you see it temporarily broke through that floor, but then it found support back again at 17. So this is a stock, if I were to call another put for next week, I would probably do below 17, because it's probably going to bounce off 17 and then fall through the floor again. And because this is a stock that's falling, I might not even sell a put. I'll have to determine that when I make my play video for next week. I haven't done the analysis yet. But yeah, so even though this one fell, you see I called a pretty good accurate floor. I called 17, and it basically fell slightly through it, but it bounced right off of it. As you can see, this is the line for 17. Kept bouncing till the end of the week. MVIS might have been another stock another put that I sold higher up on. I can't remember. Let's go to Riot. Riot, I had called a $30 floor. It started at 30.83. It temporarily, because crypto was clobbered the beginning of this week. Bitcoin had dropped to like 28,000 somewhere around Monday, Tuesday, Wednesday-ish. This is about Monday, Tuesday-ish. So Riot had broken through the $30 floor because of crypto, but then crypto kind of stabilized, and so the stock jumped up and it went up again. And so I called a pretty good accurate floor at 30. And then Workhorse, this is also one where I went ahead and I bought myself out of put positions and sold new ones. I called a $13.50 floor, which is about at the bottom of this graph. You see it traded sideways a little bit, it fell, and then bounced right off of this 13.75 line, and it bounced up higher. So let's go look at a 3-month, 6-month. Yeah. So yeah, you can see I called out pretty fairly accurate floors. There were a couple of times on both Blink, definitely Fubo, and definitely Workhorse, where I bought myself out of my puts for pennies on the dollar, and I sold more to get higher premium. Let's check out my gains for the week. You'll see that I started at 26,262.59, and I ended up at 27,416.13. If we go to my projected versus actuals, so remember I said I'm pretty fairly good at getting between 2 to 3% returns. And if sometimes I get 2%, sometimes I get 1%, that averages out to 2%. 3% plus 1% averages out to 2. So I'm starting, as you can see, I'm starting with a balance of 26,262.59. 26,262.59. If I were just getting a 2% return, you would see I get a $525 gain, and I'd have 26,800 at the end of the week. Because I was able to buy myself out of my put positions, and because I bought one option, I'll go through that later, I'll explain that later, I was able to leverage my return up to almost 4.5%. So instead of only getting $500 in return, I got $1,200 in return, and my ending balance was $27,400. If I had got a 2% return, the annualized rate of return, right, if I don't take the money out, if I just leave it in the account and keep buying puts with it, the annualized rate of return at 2% would have been 180%, i.e. I would double my money. If theoretically I was able to maintain the rate of return that I got this week, that's the equivalent of 8xing your money over a year. Now, that being said, I think 2 to 3% is a more reasonable gain for my methodology. This is a pretty good week. because the option that I purchased performed really well. You'll see here this ASO call. I bought it at $7.70 a couple weeks back, and it's now worth $9.25 because the stock went up a lot quicker than I expected. It went from 38 to 42. In the span of 5 days. That was pretty good. I would expect this stock to top out at probably 44 to 45. It might keep going higher, but at that point, when you look at a PE ratio compared to Dick's Sporting Goods, when it goes above about a about a $45 per share, about a $45 share price, then it's getting into the slightly overvalued category. Unless, of course, if by the time it gets to that $45 price, the earnings go up, and then therefore that justifies a higher price. But as is, I'd say a $44 to $45 share price is about what you'd expect for a reasonable valuation based on PEs relative to Dick's Sporting Goods. So going back. Yeah, so this week was a bit abnormally good because the stock market was rising so fast. I was able to buy myself out of my puts, and my call really my purchased option really performed. Normally, I'd expect to get a 2 to 3% return. And remember, guys, this is a forget it or a set it and forget it strategy. If you want to set this once and forget it for the rest of the week and just collect your premium, you're pretty much this week you're able to do that. You wouldn't have gotten as much gains as I had because I leveraged those gains up by buying myself out of positions and selling closer to the floor, what I like to call chasing the floor. So I was able to leverage my gains up by just checking in twice a week, like once on Tuesday, once on Thursday, and I bought myself out of positions when I was about 80% gain on the put. But if you want to set it and forget it, probably 2%, 2.5% is a much more reasonable expectation of the kind of gains you would have got this week. So yeah, this is an example, at least the first week, set it and forget it. It's kind of working. Now if I can just do this for another 206 weeks, hopefully I'll be at, not 206, let's go back up. Let's go to here. If I can just do this for another 184 weeks, I will be a millionaire. Hopefully, fingers crossed. So let's go over my strategy, my allocation in more detail. I like to sell cash-covered puts. As I said before, a cash-covered put is, the way I'm doing it, I try to find a floor that I don't think the stock will go below in the next week, and I sell a put right there. I try to aim with high beta stocks between 2 to 3% to average to 2.5%. Now, what was I going to say? This is, in this way, by doing it this way, I'm kind of selling insurance. So the person who's buying my put is, not talking about the speculator who's trying to short the stock, the person who owns the stock and is buying this put, I'm selling them insurance. If the price goes below that, they lock in their gains by forcing me to buy their stock. If the price doesn't go below that, I've basically insured an event that didn't trigger, so I keep the premium free and clear in my pocket. So I'm kind of like selling insurance in that way. And I like to keep my portfolio 98-2. 98 selling cash covered puts that I expect to get 2 to 3% return on. 2% on a purchased option, whether if I purchase a call or a put, it depends on the stock if I think it's going to go up or down. The reasoning for that, the differences for that, when you're selling options, it's extremely easy to make money. Especially if you sell a call right above the ceiling, or if you sell a put right below the floor, the predicted ceiling and the predicted floor, you're basically realizing the premium free and clear because you're selling a call to a person who's never going to have an opportunity to benefit by acting on the call, and you're selling a put to a person who's never going to have the opportunity to act on the put. no one would want to force me to buy their stock for less than what they can get it in the market, and no one would want to force me to sell my stock to them for a price that's higher than what they can buy it for in the market. So it's in that respect, if you're able to, judge a good floor and a good ceiling, which, judging a good floor and a good ceiling is much easier than predicting the direction the stock will go, whether it'll go up or down. Or at least in my opinion it is. I'm pretty good at judging floors and ceilings. At least I'm pretty good at judging floors. But anyways, so the way I sell options, I earn, at least puts, right? You get more premium on puts than you do selling calls. So when selling puts, I'm pretty good at getting a 2 to 3% return. So I keep 98% of my portfolio selling puts to get a 2 to 3% return. Now, when you buy options, it's super high risk. Options, when you purchase options, you're purchasing a derivative that has an expiration date. Because of that, it's subject to what's known as theta decay or time decay. So as time goes on, that option is depreciating quickly in value. And so the reason I don't buy options all that much is because they're an easy way to make a lot of money, but they're also an easy way to have your investment devaluate to zero completely. So I keep the options I do buy limited to 2% of my portfolio. That way, if the options I do buy devalue down to zero, they're only going to net against the 2% premium revenue I make from puts. That way, if I make a bad decision here, at least I make enough money here that they offset each other to zero. Now when I do call option plays right, I do make good money. As you can see here, I had $1,100 in gains, remember that. And of those, crap, I hate when I accidentally do that. Let's add widget. Positions. Where's positions? Positions. So you'll see here that when I keep doing that. I'm sorry, guys. I'm sorry. Add widget. Where's my positions? Positions. Maximize. Sorry, guys. I'm on a medication that gives me a dry cough. Anyways, you'll see that of the $1,100, $150 of that $1,100 is my call profits, right? So of the profits I had, 10% of my profits came from the option I bought. So it's by keeping the options I bought to less than 2%, or I think it was actually 3%, 3.5%, 4% in this case, but by keeping it a small enough portion, worst case scenario, if the option devalues to zero, it only offsets 1 week worth of premium income. Best case scenario in this situation, when it does good, in this case, it accounted for 10% of the money I made. So a 2% portion of my portfolio accounted for 10% of my profits. So to me, that's a win-win. Especially if you're a person like me who doesn't like heartburn of seeing their values decline quickly. A couple weeks ago, I lost $4,000 buying options. So now I play it a lot more, conservative, balancing my sold options against my bought options. So yeah, you can see by keeping the purchase options to 2%, in this case I was able to leverage my gains higher but still mitigate any risk of if they devalue to zero, I still would have been neutral for the week. I wouldn't have lost money. And let's see, $900 divided by my current portfolio balance of... So, equals $900 divided by... So yeah, my current balance of the options is 3% of my portfolio. So this is a good ratio for me where if it divided to zero, I keep my premium income offsets it. If it does great, it exponentially increases my premium income. And then you can see the rest of my portfolio is the puts I sell, the Six Flags. I don't know if I called this throughout the week. This might have been a put that I sold midweek that I didn't call in my original plays when I bought myself out of another put. But Six Flags did good, Shift did good, MVIS did good, Halliburton did good. All of these plays I called did pretty good. And I'm going to keep these premiums free and clear because they all expired out of the money. And so, yeah, that's my investing methodology. Just to really hammer that, buying options is extremely risky. High risk, high reward. And when I say high reward, you can make 20, 30, 40% in a day, in a week. But I keep it to 2% of my portfolio because I'm not historically good calling options. And I'm not going to ever publicly call the options I do buy on YouTube because I would just be afraid that I would, cause you to have losses if I did. I'm fairly confident about my put plays, so I'm willing to advertise those openly. But that being said, do your own research, do your own due diligence. The two ways I mitigate having losses when I buy options, keep it at 2% of my portfolio. And then you can also see this is a January 2022 call. So when you buy calls 1 to 2 years at a time, your theta decay is a lot less because you're only losing 1 day or 2 day or 3 or 4 weeks out of a 1.5 year option. When you buy a 1 month or a 2 month call or even a 1 week or a 2 week option, the theta decay is crazy. You're literally losing like 20 or 10 or 5% of the value every day. So if the stock trades sideways, you're losing money. If it goes the opposite way you predicted, you're losing money. And often, right, let's pull up Microsoft Paint. Microsoft. Let's just do Paint. The usual thing for stocks, if you'll see, they're almost never at their floor or their ceiling. At any given time when I'm calling a play, it's mid-floor or mid-ceiling. Like if you take like a 2-year floor and a 2-year ceiling, it's usually somewhere in between those. So let me see if I can find the... Yeah. So right, if this is a stock's floor and this is a stock ceiling, a stock is usually doing this, right? And so if you try to call it at any one point buying an option, if it trades sideways, you're losing money. Or if you call the direction, you're losing money. If you called it to go this way and it goes this way, you're losing money. Or if you called it to go this way and it goes this way, you're losing money. So buying options, if it trades sideways or if it goes the opposite direction you planned, you're losing money. The reason I like selling calls and the reason I like selling puts, I just have to gauge this line accurate to sell puts. And I just have to gauge this line accurate to sell calls. The stock can bounce around in between there as much as it can, as much as it wants, and I'm still pocketing money as long as the stock price ends up on the right side of the line, right? So at any given time, I probably only have to be like 95% accurate. I mean, at any given time, 95% of the possibilities are resulting in money for me when I'm selling a put, right? So if I'm selling a put here and 95% of the time the stock is above that put price, then I'm making money. Whereas when you buy a call or when you buy a put, it's basically at any given moment it's probably a 50-50 shot of it going up or down. So that's why it's pretty much high risk. So yeah, those are the two options I mitigate buy option side risk. I keep it at 2% of my portfolio, and I buy 1 to 2 year options at a time, and then I get rid of them when I think the gains are no longer to be had. But yeah, so this is the to wrap up everything, guys. I started with 26262, as you can see here, 620 26262.59. I ended up with $1,100 in gains, 27,416. I try to average 2 to 3% a week. This week was really good. I averaged almost 4.5%. If you can average 2 to 3% a week, and if you can save up $1,000 and start investing this way, you'll have $1 million in something like 6 or 7 years. I'm starting out with $26,000, so I expect to have, not including taxes, of course, I expect to have $1 million, and also not including contributions from payments. From deposits after I'm done paying off my truck. But you can see I expect to be a millionaire just based on an average 2% return in... Okay, that did not work. I expect to be a millionaire in 3.5 years. Once again, not including taxes. If you include taxes, that probably puts a crimp in your compounding rate of about 0.5%. So yeah, 4.5% return, 98% portfolio selling puts, 2% selling calls. This was a pretty good week for me. Let me know if you liked the video. Like, subscribe below. If you have any comments, let me know. Thank you for tuning in, guys. This was an awesome week in the stock market. I hope you participated. If not, I at least hope you learned something. And I hope you guys have a great weekend. Have a great day.